if that makes sense. Hi guys, thank you so much for joining me in another video and welcome to my channel if you're new here. Over the past few weeks I have realised that I've been posting quite a lot about the markets and I've kind of skipped a little bit when it comes to the stock market basics. You know, that sort of running before walking phase. So let's rewind a little bit here and I'm going to talk about my stock market 101, all the useful things that I found as a beginner. Everyone on this channel and within the community love the idea of passive income while you're sleeping, while you're dreaming, and that is great. It's the perfect situation that you could be in. Yes, there are some people out there that hate their jobs and want to get out quick. If you're like me, I love my job and I'm also cognizant of the fact that life is long and it comes with its challenges. But to diversify those income streams is just pure common sense. So let's jump into these stock market basics. Cue intro. Stock market investing is an accessible, not easy way to generate passive income. With passive income, you put your time in up front and it's rewarded multiple times. Say if you're writing your own book, you have to spend all of that time up front, putting in the hours, putting in your ideas, writing, editing, only for then it to be published and then make you some money at the end of it. And in the process, it may be that as a writer, you've given away a lot of content. You've written free articles, you've written in newspapers, you've published across other media sources. And so you may be doing some work for free. Hopefully by the end of it, you can build up some royalty type payment model. Investing in the stock market is the same. You have to put that time up front. You have to study, research, put in the time and hopefully pick good companies that will pay you over the long term. There has been a lot of debate about day trading. Day trading is not a passive income. People tend to confuse stock investing and day trading. Day trading is active income. It requires you to be on your computer, searching, trading, actively on a daily basis. If you don't trade, then you may lose money, and the problem with that is you leave yourself vulnerable to the market, and if the market decides to change on a whim, you may lose out on an opportunity. Well, I guess what I'm trying to say is when the market does decide to have a crazy day, you don't want to be sitting on a beach sipping margaritas somewhere, do you? Because you will just miss out on all that. By the by, the point is day trading is active, not passive. Investing, on the other hand, is finding great companies and putting your money in and hoping that they're going to pay you over the long term. When I'm reviewing companies, I tend to think about three broad categories. First one is whether the company is value for money. The second one is whether that is a quality stock. And the third one is what kind of momentum does that stock actually have. The best strategies are to find companies that are generally trending upwards, and it's what us Brits called having a good batting average. I think in baseball you might call it loading the bases. I don't know, tell me if I'm wrong down there. But the idea is to find great companies by looking at the company fundamentals. Find them cheap and buy the stocks with momentum in their favour. And that brings me quite nicely onto everyone's favourite stock at the moment, Tesla. It's a great company and you can't fault the momentum, but the problem is it has a tough time reconciling its value. And it does bring me on to the fact that investing generally is a very personal thing. There's a lot to choose from. Our parents probably would have preferred high quality stocks paying dividends over the long term. They would generally care much less about the direction of the stock. Provided the company is solid and the yield is good, it's a buy. In any case, the point I want to make is that it takes time to pick these stocks. Spend time trying to figure out what you want your portfolio to do and then pick stocks that will do exactly that for your portfolio, if that makes sense. When buying a company for income, you're buying something which is called a share. Us Brits call it a stock. All that essentially means is you're buying into a company's stock to share what the profit that the company makes. So for example, if you bought $100 worth of Apple shares, you would get $1 per year of dividend. Compared to McDonald's, for example, if you invest $100 into the stock, you will get approximately $3 as your dividend yield a year. I do want to point out that I'm talking about yield in terms of how much money is invested rather than the number of stocks, because that's how yield is calculated. And also to buy one stock of McDonald's is about $180 compared to Apple, which is over $380. But with fractional trading now offered by e-brokers, it's possible to not only buy a whole stock but also a fraction of it and then still reap the rewards at a smaller scale. And that just makes investing a whole lot more accessible from my 16-year-old sister to my colleague at work. Next question that I ask myself as a beginner investor is, what am I buying? Is it a public or listed company? Stocks that you buy are called public or listed companies, and all that essentially means is that the stock is available for the general public to buy and is listed on an exchange. There are a number of different requirements for a company to be public. For example, updates on insider ownership, and filings to the exchanges and the regulators that control how the market is run. And that makes perfect sense because there's external money coming into an organization. And some examples of large companies that are private include Fidelity and some large big accounting firms. Stocks which are first sold to the public are called IPOs, and these are the initial public offerings. At this point, any cash that is invested goes straight to the following. Then you are buying and selling within the market, and if a company wants to buy back its shares, it can do that again through the market. What this essentially means is that the share price for McDonald's or Apple depends on the supply and demand in the market. So the question is, buy or sell? Companies tend to do well when the economy does well, so more buyers come into the market and thus drive the share price higher. It's quite incredible when you think about it because the process itself is automatic. So you may go to work, you have your paycheck, and automatically your money is invested within your pension. That money is then put directly into your pension or given to a fund manager. And as we make more money, we have hired more people to buy more stocks. And this is what drives most of the demand within the market, and it's called institutional buying. Then the excitement comes from when the prices of a stock go higher and higher, and there's a lot of frenzy within the market about a certain stock. And then we get to a point where the market realizes that expectations are way out of kilter, and so a correction is around the corner. And nobody wants to be caught out naked when the tide goes down, do they? And then as a shareholder, if we realize we're holding shares that are way overvalued, we try and sell. But when you try and sell, nobody wants to buy. And that's what ultimately pushes the price down again. It's almost like a negative positive feedback cycle. Then you have the media on the outset, pulling and pushing in both directions, almost like an elastic band, causing overshoots in either direction. And the media refers to those pulls and pushes as booms and busts, and the market refers to them as corrections and excesses. And the weird thing is, all of these things are normal. So the question is, how do you do it? Warren Buffett said, buy when everyone is running away and sell when everyone is piling in. And that does require an element of understanding market fundamentals and timing the market. But who can even do that? Timing the market is notoriously difficult, and the majority of people that do it just fail, and that's just a sad fact. If you are a retail investor that wants to time the market, you will probably fail, and over the long term, the market always outperforms the retail investor. Having said that, there is a lot of research that can go behind finding the right companies and investing over the long term that will generate returns, and using your rules and solid fundamentals to pick those stocks at the outset. I've talked about dividends in another video, which I'll try and link up here. So that is investing, drip investing, and investing for the long term, providing returns in the market. The other way to make money is to sell stocks, obviously. If you invested your money at a lower price and then you end up selling at a higher price, then you will make money. The other way to make money is to sell stocks, and that at a profit. And that only becomes realized when you actually sell the stock itself. Saying that always brings that scene into mind with Leo and Matthew McConaughey. I do love them both as much as I love Ryan Gosling, by the way. The other thing that I haven't talked about is shorting, and that is profiting from a company when the share prices fall. And that, I think I'll do another video on, to be honest. The 3 basic ways of making money in the stock market: buying, selling, and dividends. Like we didn't know anyway. Just to wrap it all up, please do subscribe, leave a comment down below what you think, give a thumbs up for the algo, but until next time, see you guys.